Hi, Jay Tyner here. Welcome to the show. By the way, anything you hear on the show today, make sure you check with your CPA, check with your tax advisor, check with your financial advisor, or check with your insurance agent. But today we're going to be talking about annuities, and we've got Mark on the line. He's actually down in Texas on the south side of Dallas in a little town called Waxahachie. And I probably said that wrong, so you can correct me, but how you doing today?
Doing great, doing great. It's pronounced Waxahachie for us locals.
Sorry about that. Okay, well, I got to get it right. Waxahachie, like walking. Okay.
There you go.
Well, let's jump into some annuities. There's like all kind of different annuities. In fact, if you get on and you Google annuities, you can find like 3 million responses in half a second. So maybe just give me the really nutshell of the three different types that may be out there.
Sure. There are three types that run on that chassis basically, and there is the fixed and equity indexed and variable annuity. Fixed annuity is very much like a CD where the company is going to give you a rate of return. You can utilize that for a year, 2, 3, maybe up to 5 years. It's going to be sometimes a little bit better than a CD rate, but it is just a fixed rate, nothing more, nothing less. An indexed annuity actually has those guarantees built into it where they do give you a minimum rate of guarantee, but then they allow you to pick different strategies within that annuity that give you upside potential with no downside risk. And so there is an availability there to create more return without taking additional risk. You never get all of the upside of the market, but you eliminate all of the downside. And then there's a variable annuity, and variable annuity is simply an annuity with mutual funds sitting on top of it. And they can be a little fee heavy with different fees built into the annuity, different fees built into mutual funds. They don't have quite the guarantee of principal that the fixed or the indexed annuity would. A lot of times they will guarantee return of premium.
Right. So those are the three different chassis that are out there as far as annuities. Let's talk about some common pluses or pros that come with all annuities. The first one that comes to my mind is basically having some tax advantage on your money as it grows. So share with us a little bit about that. And by the way, Mark has been in the insurance industry for going back to the early 80s? 83?
Yes, actually, yeah, 82, 83, and that area is when I first originally started.
Okay, so 40 plus years being in the insurance industry. So again, a great resource, and I want to thank you for joining the show today. So some of the common things that kind of flow through all annuities that could potentially be a plus would be the tax favored status. Now, we can't say it's tax-free status like a Roth, but we could say it's tax deferred. So tell me a little bit about that in all the annuities.
Correct. In annuities, if you have non-qualified dollars, your interest grows tax deferred. So you're not taxed as you go. If you compare that to a CD, you may be getting a 0.5% to 1% in your CD, and then that's going to be taxed each year, whether you utilize that money or not. With any of the annuities, that non-qualified dollar is going to grow tax deferred. And so you get compounding interest. You get interest on your principal, you get interest on your interest, and then you get interest on the tax dollars that you would have had to send to Uncle Sam. And so that allows for a lot more growth. Now, they will be taxed on what's called LIFO, last in, first out. So as you make withdrawals, the interest comes out first. So there will be taxes paid as you indicated, but it'll be in the future, and actually the net dollars to you will be greater by deferring those taxes.
So a lot of people are using the tax deferred status of annuities to maybe help manage part of their taxable consequences during each and every year. So with a responsible use of an annuity in order to get some tax advantages, we've been given that. You're not breaking any law. That's what's available in those kind of products. And so that kind of flows through all of them. When it comes to maybe any other advantages across the board, there could be some state-specific advantages because as far as I understand, when an annuity company wants to offer their product in a state, they still have to abide by some of the Department of Insurance rules for that state. So for example, Texas could have a kind of a different twist on how they see it and perceive it and how they offer their products. And then maybe North Carolina or Virginia or Florida may see it a different way. So it is state-specific. Can you speak to that just slightly as far as maybe some of the things that come into play when you look at a product in a particular state?
Sure. In the state of Texas, any of the annuities are going to be considered creditor protected. So if you ended up, as the economy were to go, in a situation where you had creditors come against your estate or against your savings, the annuity is going to be considered creditor proof. And so that is one advantage that Texas has over a number of other states. There's a couple others out there that do that, but Texas is one. Some of the other things is when we look at income streams and situations like that, they can be a little different. So you definitely want to have somebody guide you through that process to find what's the best fit for you.
Right, that's what I was going to mention here. So obviously on the show, we're just talking about the general things of annuities. We're not giving specific advice. And again, I encourage everybody that if you're looking into an annuity, you want to know how it works, or you want to consider it inside your overall investment planning, is to sit down with somebody that's licensed, an insurance professional that's licensed in your state that you wish to particularly invest in. So if you're in Texas, you want to sit down with a Texas insurance authorized person that has that license and knows about the products and can give you the information on that, just like you would if you're in North Carolina or in Florida or any other state. You would want to sit down with an insurance agent that's licensed, not only licensed, but also licensed for that particular product. So I understand, and of course I've been licensed, I don't know, not quite as long as you, Mark, but almost as long, just real close. And one of the things that the insurance companies have afforded to them, and we cannot use this to induce somebody to actually put their money in an annuity, but since we're not telling anybody that they should be putting their money in annuity right now, all we're saying is how do annuities work and what are some of the benefits or the pros and the cons. And one of the things that many annuities have, the fixed annuities, they participate through the state guarantee association. What that means is that most annuities are not guaranteed by the FDIC. They're not a bank product, but there are some things that would help you understand that there is kind of a safety net under the money that could be an annuity. And of course, there's limits, there's requirements, there's state specifics, there's all that. All I can say here is go to your state and Google the state guarantee association, and then it'll pop up and you can read that information. Anything you want to add to that?
Not at all. Each company also has a legal reserve, and again, that's getting a little bit down into the details, but there's a layer of security in there when it comes to the insurance companies, and then of course the state guaranteed fund. So the guarantees that are built into that are quite sufficient.
Yeah, and in order, again, to talk here on the show, just to be very compliant and specific, the claims paying ability of a particular insurance company that you happen to put money with, you need to check with them, check with their reserves, and understand how that works. All right, well, we didn't say a whole lot about a variable annuity, so just real quick, let me make a comment there. There are a lot of folks that have, again, as you said, Mark, they have invested into variable annuities, and when you invest into a variable annuity, you're taking your cash, your money, and it's being put into what we call sub-accounts. And a layman's term for sub-account is a mutual fund, as you mentioned. So it looks, it acts, it basically has the feel of a mutual fund. And the only thing I can say here is that mutual fund has fees. I wrote a booklet on the 6 fees and costs associated with mutual funds. So now you've got those particular costs inside the annuity. But then if it's variable, typically what people will do is when they buy a variable annuity, they'll want to have some security because their money is in the market. So they'll buy some extra add-on features. We call those riders. And many times riders can have a 1% a year fee. Some have a 2% a year. Maybe the mutual funds have a 1% fee. And so by the time you add it up, typically what we see across the board, and again, this may be different for the one you're looking at or the one you have, but in a general way, what we've seen is variable annuities will have a fee anywhere from 3 to 4% each year. So for example, if the market goes up 14% and you had 4% in fees, then you'd get about 10. If the market went down 10%, then you could potentially have a total cost of 14%. So again, you want to look at all these different advantages and pros and cons if you're going to use an annuity. And again, check with your advisor. We've talked about 3 different types of annuities. First was the fixed, and we talked about the indexed, which is called an FIA, fixed indexed annuity, and then the variable annuity. A lot of different choices to pick from. Maybe it fits in your portfolio, maybe it doesn't, but hey, check it out. And again, we'll see you next time on the show, but be careful when you're looking at any kind of a financial instrument to check with your CPA, your accountant, and your financial advisor. See you soon.